So, you've invested your money. How do you reduce the risk of losing it? Let's walk through some common ways that you can protect yourself. Number one, own assets for a long time before selling them. Stocks, bonds, real estate, all of these markets are volatile in nature, meaning that prices are constantly going up and down, but they tend to increase in value with a longer time frame. So, the longer that you own something, the more likely it is to increase in value. Number two, don't invest in assets you don't understand. If you don't know how a company makes money, you might not want to invest in that company. And a simple example from my own life is that I know very little about cryptocurrencies, so I choose not to invest in cryptocurrencies because I don't understand the risks associated with them. Number three, don't buy or sell assets based on emotion. This is probably the most important one, so I want you to take note, and I'm going to share a quick story to emphasize the point. I have a friend who is in his 60s. He is retired. And if you think back to a couple years ago, when it came out about COVID-19 and the pandemic starting in China, spreading to the Americas, this was a very volatile time for the stock market. And unfortunately, the value of most companies plummeted. My friend, his investment portfolio dropped by 30%. And quite frankly, he panicked. He was worried he was going to lose his entire retirement and that the stock market was going to bottom out. So he sold almost all of his investments, suffering a 30% loss in one day. Now, the saddest part about this story is that if he had held on to those investments, within 2 months, the stock market recovered to its original levels. Because of an emotional decision that he made, he essentially lost 30% of his wealth that he had in retirement. Please, please, please do not do that. Stay the course. Hold on to things for the long run. Things go up and down, and that's just normal. Okay, so one quick note I remembered afterwards about that story. He actually did realize his mistake and reinvested a couple days later, so it wasn't as bad as it could have been, but it could have been really terrible. So please just focus on the main point of the story, which is don't buy and sell based on emotion, and you'll do much better and get higher investment returns. All right, number four is own different types of assets. This is something called diversification. We're not going to get into all of the types of assets in this course, but stocks and bonds have different characteristics, and by owning some stocks and some bonds, that's a really easy way to diversify. And lastly, do not invest in risky assets, especially if you don't know what you're doing. I'm assuming you're taking this course because you're starting your investing journey, so just play it safe for a while until you understand the rules better. What would be some examples of risky assets? There are things called penny stocks, really small companies that have a high level of risk. And on the bond side of things, there are things called junk bonds, potentially companies that are going to default on their loans. Just avoid those. Don't invest in them for now. This advice may seem really simple and obvious, but I promise you, there are loads and loads of investors that don't follow it. And if you just follow the principles on this page, you will be okay. Next up, let's look at some different strategies for investing and how often we should be investing.